Today we're diving into a huge move by HSBC $13 billion share buyback. But here's the twist, it's happening right after a 25% drop in profits. So what's really going on here? And should you even trust moves like this? HSBC just released its first quarter results, and they weren't pretty. Profits plunged by 25%, mainly because the bank sold off businesses in Canada and Argentina, taking some heavy one-time losses, and it gets worse. HSBC also set aside $900 million to cover potential bad loans linked to the escalating US-China trade tensions. Basically, they're bracing for more trouble ahead. If you're a regular investor, news like this usually screams danger. Falling profits, rising risks, time to stay away, right? Well, not so fast. Despite the rough numbers, HSBC announced $13 billion share buyback. That's a strong and unusual move in a shaky environment. Why would a company do this after bad news? Because buybacks send a psychological signal. It says, we believe in ourselves, we think our stock is undervalued. We are backing ourselves big time. When companies repurchase their shares, they shrink the number of shares available in the market. Fewer shares usually mean higher earnings per share and potentially a rising stock price, even if the underlying business isn't actually getting stronger. It's like putting a fresh coat of paint on a slightly cracked wall. It looks better, but the cracks are still there. So should you jump in and buy HSBC stock now? Here's the hard truth. The $3 billion buyback might support the stock price in the short term, but the bigger risks, like the global trade war, rising loan defaults, and slower economic growth, aren't going away anytime soon. If you're an investor thinking long-term, you have to ask yourself, are you investing in a recovery or in a temporary cover-up? Sometimes buybacks are a smart move. Sometimes they're just a way to buy time. Choice is yours. Would you bet on HSBC right now? Or would you wait and see if the cracks start showing? Let me know what you think. And don't forget to follow for more real talk on global markets.